When we're looking at the market structure, we can use many tools to help us identify potential ideas to act upon. Whether we're using technical indicators, pure price action, referencing something such as a Wyckoff schematic, identifying various patterns, or even putting ourselves in a smart money mindset. All of this is irrelevant if we do not understand this fundamental basic concept. Candlesticks. But really, what is a candlestick? This video is going to help you understand three main components of the candles. First and foremost, we're going to define what a candlestick actually is. Secondly, we're going to take a look at an order book to help you visualize what causes candles to be created. And third, I'm going to give you more perspective on what it means to think like smart money. So let's get started. A candlestick, in the purest form, no matter the time frame, no matter the chart, is simply a visual representation of orders that have already been filled in the past. Every single second that we see price moving, whether we're looking at a monthly time frame or whether we are down in the second time frames, there are buyers and there are sellers in all parts of the world being matched together. And each candle shows us a visual representation of where those trades actually happened. Now, a candle can only form if there is a buyer and a seller. And thankfully, because of digital currencies, we can look even further behind the scenes at an order book to have a better idea of what's actually happening. What's in front of you right now is the platform Bitfinex. This is one of many digital currency exchanges. And right in here is their order book. Now, some platforms will give you access to level 2 data, and you get a limited amount of information for where others have pending buy limits and pending sell limits. Some platforms will give you the real-time and price data of where orders are being matched. It may be referenced to as time and sales. Most digital currency exchanges give you all of this information and more. When we're looking at an order book, we're going to see pending buy orders, the amount, and at which price levels people are waiting to get into the market at. This is money that is sitting there, waiting to actually enter the market. On the sell side, we're going to have pending sell limits. Same information, we get to see the price, we get to see the quantity, and sometimes we even get to see how many orders are actually open. This is money that is looking to get out of a particular market. So we have buyers that are waiting to get in at lower prices relative to where the market currently is. We have sellers that are waiting to get out at a higher price relative to where the market currently is. And then we get the real-time action. Every single moment that a buyer and a seller are matched, the candlestick is going to update and give us a visual of what has just happened. The amount of money coming in or out of the market at any given time is heavily dependent on participation. When there are thin order books, we'll occasionally see stuff like this. We have GBP AUD on the daily time frame, utilizing the FXCM data feed. Notice anything strange? When we compare this with Oanda, let's take a look at FXCM once again. Take a mental picture of the information that you see on this chart. Seems a little bit funny to me that we have this large movement, and yet it doesn't exist on this data feed. Sometimes it's not as obvious. Bring your attention to this point on the screen. When we switch over to a different data feed, we can see that the same asset, silver, has an extended price movement on this data feed. That is because all the order book is a place where people can put their buy limits, put their sell limits, or take immediate action to get in or out of the market. And then the candlesticks show us what happened. To help you understand what a thin order book is even further, think of what typically happens during the holiday season. People spend more time with their family, do fun things that they enjoy, and take time off of work. In the realm of trading, this translates to less buyers and less sellers. This means that there are less price points that people are actually willing to buy or sell at, regardless of if it's a currency, a commodity, or a stock. During certain times of the day and year, there are going to be lower levels of market participation and less liquidity. Sometimes the market will gap. Other times, it will move back and forth very quickly. Let's take a look at what happens when there are low levels of liquidity, not much market participation, and a large amount of orders that suddenly enter the market. Being on the wrong side of that move would be absolutely detrimental. Almost as if you were peacefully minding your own business, swimming in the ocean, and a great white shark appeared from the depths. In that moment, rather than trying to fight the shark, you would wish that you could be positioned alongside it, like one of those remora suckerfish. You see, the individuals that are moving the market will do absolutely anything to capture the most amount of money. Each and every single candlestick, it shows us information about what has already happened within a structured yet chaotic environment. And the candles that have yet to be created will always move towards where the most money is, just like the shark stalking its prey. If you're asking yourself, where is the money? Shift into the mindset of smart money. Imagine for a moment that you are the one who is moving the market. What steps would you take in order to get price from one point to the next while minimizing your risk and maximizing your potential profits? Would you use manipulative tactics, such as allowing people to believe that they were right on the positions they took initially, only to move the market in the opposite direction? Would you temporarily sacrifice capital, knowing that you could just sit in drawdown, waiting patiently until the market eventually comes back to get you out at break even so that the remainder of your position can float into profit? Would you take others out of the markets, collecting their orders before the true move happens? The entities moving price are both human and artificially intelligent. When it comes to market participation, there are very limited morals. For one person to win, another must lose. The market environment is a transfer of wealth. And the main difference between smart money and you is the amount of capital that they're working with. If you have the discipline, however, to put yourself in their mindset, the only question that remains is, do you have enough patience to continue moving forward and withstand the test of time?